back with closing trades, and we have a whole host of experts who've joined us on the show. Of course, Kunal is still on with us, but we also have Mr. Sunil Subramaniam, market expert, and Shivangi Sarda from Motilal Oswal Financial Services on the technicals, also joining us. Good afternoon to all of you. Kunal, just before we take it across to our other guests, just want to get your view on the kind of move that we've seen on some of the names today from the broader end of the market. And if I pull up the Nifty 500 and take a look at what's buzzing over there, it's names like Dixon Tech on the losing end, but it's Newgen Software. Praj Industries. Praj is doing very well, in fact, on the back of its earnings and strong management commentary. Multiple days of gains coming in for Praj. Something that's up by another 11% today. How is this shaping up on the charts? That's Praj Industries, yes.
So yeah, I'm very bullish on the stock, and specifically, I think given the last 2 weeks of chart patterns for Praj Industries, because what happened was a month prior to that, there was this huge volume candlestick for Praj Industries, something which the stock had not seen after more than a 40 to 50% correction. Remember, I think 2024-25 highs for Praj was almost 840, 850. From there, the stock had fallen down to as much as 300 in the recent past. So after such kind of a vicious correction, the stock for the first time had seen a major volume uptick. Post that, the stock fell down back again towards a 10% correction. And now subsequently in the previous 2 weeks, the stock has seen a huge jump in terms of volumes. So this indicates that there's been a significant change of stance which has happened from the buyer's intent for Praj Industries. And this indicates that the stock is looking extremely lucrative and attractive at current levels. But over here, I would advise that don't keep a short-term time frame, because after such kind of a strong 10% kind of an up move, the stock is bound to get into a zone of consolidation because the index itself is into that kind of a range-bound mode. So I think in this context, the time frame has to be at least 3 months to 6 months or more for someone who's looking to buy the stock at current levels. But yes, I would advise a buy on Praj Industries at current levels as well as on minor dips with a potential target range, say with a 6 month plus to 12 months plus kind of a time horizon of almost 380 to 400 for the stock.
That's the take on Praj Industries, the levels to watch out for on the charts for that one. But Sunil, hi, good afternoon, and thanks for your time today. Before the break earlier in the show, we've spoken about IT, we've spoken about banking and metals. But the one sector that we haven't addressed on the show as of yet is the FMCG space, and particularly the staples, the kind of volume growth, margin expansion that we've seen across the board for some of these companies. Is now a good time to start looking at FMCG as a sector that's something more than just a defensive play? Do you believe that there are more growth opportunities ahead now that the GST impact is done? We've had the budget also that's gone by. Trade deals have been signed. On the consumption front, everything looks optimistic. But what about staples particularly?
No, I would say that staples would still be secondary to discretionary, in my opinion. The reason being that, see, the GST cuts for FMCG, right, essentially are in a small pack volumes, right? So it means that the pack price will remain the same, but they'll add more stuff into it, whether it's a biscuits or, any kind of a low-end price product. So more quantity. So there won't be a saving from a customer perspective per se. He'll get more bang for the buck. You may say if it's 5 rupee packet of biscuit will get maybe 60 grams instead of 50 grams, just allegorically. So to that extent, FMCG companies, volume, if people stick to the same amount of rupee purchasing, their volumes will go up slightly. But what's hurting the FMCG is the rural demand, because low inflation in rural India means the farmers are getting less income. And so the rural is, I think, the pressure situation. So from that perspective, I would say the coming monsoon, it's probably better to wait for the monsoon. If there's a good monsoon, good harvest, people get more money in their hands, it probably give a trick. Whereas urban consumption, I don't have a problem because, like I said, the GST cuts are really felt in the urban side. That's number one. Number two, from an FMCG, one is the top line growth. This is what I talked about just now. But on the bottom line, you've got to look at commodity prices, which are the main source of raw material for them. So crude prices make a difference. Pulses and cereals, because they all go into wheat, and maida, which goes into biscuits. So you've got to look at and the international price scenario there, and where we import stuff, the rupee depreciation. So it's a combination of factors. And hitherto, it was always bought as a safety sector by FIIs. But we know that FIIs have been a selling spree. That's why FMCG has been under pressure. Because domestic investors, DIIs, don't really like it much, because India is a growth market and they'd rather buy something which looks good from a growth perspective because valuations in India are still not cheap. So I would say that DIS would also tend to do consumer discretionary preferentially over consumer staples. So to my view, when FIS come back, then it will be a part of their safety pick, and that's when it will get support. And otherwise, I think we have to watch and wait for the monsoon trends and how the rural economies pick up before us to really take a call on FMCG.
Okay, so lots of factors to watch going ahead, but still, according to Sunil, discretionary is better placed in this entire consumption basket than staples. Shivangi, hi, good afternoon. Thanks for your time. Talk to us about how some of these companies are shaping up on the charts. Let's start by talking about staples, then maybe we can move ahead to consumer discretionary. First, from the staples basket, among the heavyweights like Nestle, Britannia, Marico, Dabur, HUL, what's looking good and what's looking more attractive compared to its other peers in the basket?
A very good afternoon. Thank you for having me. So, very honestly speaking, these stocks have moved in a laggard manner for most part of the year, most part of last year, and we can see that the movement is kind of continuing here. They have moved in a very range-bound manner, not really performed quite significantly year-to-year basis, and from the last 3 years, in fact, we've seen that. The range has been intact. So I'm not very, on the larger time frame, of course, the stocks could do well, but on an immediate basis, not very, bullish on the immediate term structure. It may move in a sideways manner, but there's no downside that we're seeing in the stocks. But of course, follow up decisively is required for the next leg of rally to begin.
Shivangi, from some of the broader consumption themes, something like electronics, white goods, alcobev, paints, anything looking attractive from these spaces?
So definitely paint stocks have been picking up strength from the lower levels of lately. But some of the white good space stocks are also looking quite good. Voltas is one of them which has resiliently held on to the strength, and it's given a monthly basis breakout from the last consolidation of the last 10 odd months. So definitely there is a good room of potential upside over here. So this is one stock that one could look out for. And of course, we've seen that there are a lot of call writers that have unwinded their position in this one. So definitely this one's looking quite positive, and we could look at the next targets of round about 1600 for Voltas with a support near 1500 levels.
Okay, Shivangi, thanks for that outlook on some of the broader consumption names. But once again, shifting focus, coming to you, talk to us about how you have read into this entire move and the entire story playing out in the IT space that we've seen in the last couple of weeks. First, the massive cut coming in on these AI worries. And today, AI is the reason why the market is doing very well. In fact, the Nifty IT is doing very well on the back of this Infosys and Anthropic collaboration that we've heard. It's been such a change of events, such a turning of the tide in the last 2 weeks itself. How should an investor in the IT space move about the space? And if someone is looking to make a fresh entry now, would you be recommending that?
So yes, so first of all, let me answer yes, I would recommend making a fresh entry. But let me explain this with a little bit of background. You spoke about the last few weeks, the earthquakes which have hit the IT industry. But there's one big difference, which is that even before the Anthropic announcement and the Palantir announcements hit IT services, which led to that huge correction of whatever 5 to 8% on Thursday, followed by another 1.5% on Friday. What had happened was that that day was actually worldwide IT services getting impacted, and India, that same impact coming to India. But Indian IT has been underperforming for a fairly long period of time because of the worry about AI. So India, because as a country we've been a bit behind on AI, the Indian companies was perceived to be very slow on adopting AI. So they have been under pressure for a long time. So my point is very simple, that if you look at it now, the correction was a bit overdone because we also got slapped with the international IT services crackdown. We also suffered, but we'd already been suffering. So even after this recovery of, let's say, yesterday and today, use 1 year return, if you look at it, IT index is down 19%. The Nifty is up 12%. So you're talking about a 31% underperformance to the market. Now, that means what? What I'm saying is a lot of the bad news about the slowness of AI absorption by Indian IT companies is in the price already. From now on, I believe that things can only get better because India is doing this big perception game with this 4-day summit about Indian AI. Second is even in the budget you saw there was a lot of emphasis put on the data centers, on getting AI enabled ready. And companies like TCS and Infosys and Coforge have been making specific investments in the AI space for some time, but it got ignored when the worldwide correction happened. So I think that, yes, we have moved a bit slowly as far as Indian IT adoption to AI, but I think we'll move surely. And that's the Indian habit, right? The culture. We are not always the first movers, but we are very good in catching up and putting. And all of these big companies have enough cash balances either to invest heavily in AI or to do inorganic acquisitions in the AI field. So over the next 6 to 12 months, I expect these things to come, and the perception of Indian IT as being a slow moving elephant in this case will change. Yes, we will still be an elephant because of the size of our companies, but I think that it can only get better. So for those who already are holding it, depending on various points of time, they can take a call. But for a fresh entrance, I think you have an index where 32% underperformance with the broad Sensex or Nifty gives you enough margin of safety cushion that you can start acquiring it. There will be volatility, there will be good news and bad news coming on various days, but AI itself is more of a futuristic impact after, let's say, 2 years or 3 years. So I don't see that the current earnings guidance, they will stick to it. Their dividend yields have improved sharply. I think over the last 10 years, dividend yield was 1.5%. Today, it's more than 3.2%. So you've doubled your dividend yield. So income-seeking institutional investors from abroad and from India would also now add more IT to that. So while I don't expect a sharp V-shaped recovery in IT, I think the worst is behind us and a gradual recovery with specifically companies who come out and make a very clear-cut plan. See, until today, you saw even in the quarterly earnings, there was no specific AI mentioned by Indian IT companies. They were kind of avoiding. Today, Infosys has come and said, okay, this much percentage of our thing is from AI. So I think that clarity is very important. So the next earnings season, we'll see all the companies come out, lay out their specific AI related plans, and there will be tie-ups with AI majors and, like I said, acquisitions. So it can only get better. I don't see much chance of it getting worse. So if you haven't already invested in IT, it's a good time to start staggered allocations across the space. And today there is still a wide disparity between large cap IT and mid and small cap. I think the correction was more in the large cap IT. So those valuations are a touch more reasonable than the mid and small cap IT companies. So I would say weight large caps a little bit more in your portfolio, but stay diversified within the IT space.
Okay, so that's a very detailed outlook coming in on the IT space. Shivanki, if I had to ask you your top pick, or let's say top three picks from the IT space, would it be a mix between the large and the mid cap names? Would you be tilting more only towards the larger caps? What would that mix look like?
So of lately, we've seen that the entire IT pack movement has been led by the heavyweights itself, and the small or the mid-cap IT names have, actually quite a lot beaten down from a long period of time. Although stocks like Infosys or Wipro or the heavyweights have kind of, shown strength only in the last only in the last couple of trading sessions. But then again, if one has to go for the IT pack, these are the stocks that I would be looking out for, the heavyweights only, because we've seen that clearly strength is slightly still missing here, and the people have to gain more confidence for the stock to again regain above its key exponential moving averages, at least on the daily frame. So little wait and watch here, but if one has to move into these, space stocks, then it would be the heavyweight ones.
Okay, so that's the thing. Sunil, weigh in over here. Talk to us about India's manufacturing prowess. Where do you think we as a country are heading in terms of manufacturing, EMS, data centers? These are some of the top themes, and of course, AI that we've spoken about that are surrounding market conversations right now. Where do you think the future lies when it comes to some of these themes? Where are you seeing value in the market in terms of some stocks that could do well?
So I wouldn't talk about stocks, but let
Sure,
me
sure.
talk about the thing that, see, Indian manufacturing, I would say, I know I heard Mr. Goenka speak now, But I think one of the key things to remember is that technology-wise, productivity-wise, skill-wise, we are still nowhere compared to China. And if you look at China's history and how they actually achieved it, because 20, 30 years ago, China was known for very poor quality products. Now, India has never been known for poor quality, but China was very bad. How did they become so very good? It's because of foreign direct investment. It's because American and European MNCs came and set up factories in China. And over a period of time, the technology transfer took place. Then Chinese engineers and everybody stepped up, and Chinese owned companies absorbed that and became world class. So India has to follow the same journey. And for that, what the government's role is to first get the infrastructure and keep your FDI policy liberal for it to come. And that's where in the budget you mentioned data centers. The government giving a tax holiday till 2047 for data centers. So the route for Indian manufacturing is, I believe, through foreign direct investment, the foreign capital coming with factories. The biggies of the world come in and set up, which the data centers is one step in. He mentioned Apple, right? It's because Apple chose India and that technology came in. It's not a homegrown thing, but over a period of time, we will get there. So I think that the clear path I see is wherever the government is opening the doors to foreign investment into India, foreign manufacturing comes and sets up with the localization component. For example, the Rafale planes, right? The new deal signed has a 30 to 40% localization. That's how Indian technology will develop. So I believe the step one in all of these places, if you are to compete in this new age world with high skill manufacturing, it has to come from partnerships with foreign and Indian companies, right? And then standalone over a period of time, Indian. So the space is there then, and even an automobile, right? With the India EU deal and everything, we're dropping tariffs on their vehicles to come to India. Even with the US, that's going to happen. But we should get them to come and set up their plants here, right? So that's the way I see going forward manufacturing, right? In one space, however, India on its own has definitely demonstrated its skill, the Atmanirbharta, and that's in defense. If you look at the drones and the UAVs, there without a foreign partnership, our engineers and scientists have developed state of the art. So I'm not saying that we can't, but it's a slower journey. It succeeded very well in one space, but on a broader basis, you want to create the employment. And mind you, even the Apple, if you look at it, what happened? It started with just assembly and then going up the value chain. So I'm saying it's a slow process, but definitely that's the way we are headed. So I would say that from a medium-term perspective, manufacturing is the space that we have to invest, but FDI is critical. So I would say that's probably the trigger for Indian manufacturing too.
So that's the outlook going ahead. Shivangi, we have a couple of minutes left for market close. Very quickly, today has been a very stable expiry day for us. Where do you see the markets opening tomorrow for the rest of the week? Are we headed for a stable week? At least, is that what the charts are indicating?
And the indices have held on, not to jinx it, but of course, we've seen that there has been a good comeback of the bulls, and there has been buying, which has been consistently seen throughout the trading session today. So overall, that is quite positive, and we will look at 25,500 as the important base here, which will decide the next stance for the index. But of course, we're heading into the monthly expiry week, so some volatile cues will be expected. But there are some call writers which are present at 26,000, which needs to unwind their position for the next fresh short covering move. So definitely we are heading towards 26,000 levels, but the support of 25,500 would be important to watch out, and buy on decline to continue in the index.
Declined is the call coming in. Shivangi, Sunil, on that note, we'll let you go. Thanks so much for taking the time out and joining us with your insights. Viewers,